Where to invest amidst Donald Trump's tariffs chaos. Welcome back, esteemed members of the Finance Compass family. It's fantastic to have you join us once again as we embark on another crucial journey through the often perplexing, yet always fascinating world of finance. Today, we're not just dipping our toes, we're diving headfirst into a topic that's dominating headlines and, more importantly, impacting your hard-earned money. The potential ramifications of Donald Trump's tariffs and how we, as savvy investors, can not only weather the storm, but potentially find opportunities within it. Now let's acknowledge the elephant in the room. The resurgence of talk surrounding significant tariffs can understandably trigger a sense of unease. We've witnessed the market's knee-jerk reactions in the past, the unsettling volatility, and the pervasive air of uncertainty that such pronouncements can generate. But, and this is a crucial but, here at Finance Compass, our mission isn't to amplify fear. Instead, we're dedicated to empowering you with the clarity, the strategic insights, and the unwavering confidence to navigate these complex economic currents with intelligence and foresight. So let's pull back the curtain and truly understand the landscape we're dealing with. We're not just talking about abstract economic theories. We're talking about real-world implications that can touch everything from the value of your investment portfolio to the prices you pay at the grocery store and the security of your long-term financial future. Deep dive, unpacking the tariff threat. The foundational principles of tariffs. At their core, tariffs are essentially taxes levied by a government on goods and services imported from other countries. The stated intention is often to protect domestic industries by making foreign-produced goods more expensive, thereby incentivizing consumers and businesses to purchase domestically made alternatives. Historically, tariffs have been used for various purposes, including revenue generation for the government and as a tool for political leverage in international trade negotiations. However, their economic consequences are often multifaceted and can extend far beyond the intended beneficiaries. The theoretical argument for tariffs often hinges on the idea of creating a level playing field and safeguarding domestic jobs. However, the interconnected nature of the modern global economy means that such measures rarely exist in isolation and often trigger a chain of reactions. The tangible impacts, a closer look. The inflationary spiral. One of the most immediate and direct consequences of tariffs is the potential for increased inflation. When imported goods become more expensive due to tariffs, businesses that rely on these imports as raw materials or components face higher costs. These increased costs are often passed on to consumers in the form of higher prices for finished goods, eroding the purchasing power of every individual. This can lead to a situation where your money simply doesn't go as far, impacting your daily expenses and your ability to save and invest. The specter of market volatility. The mere anticipation or announcement of significant tariffs can inject a significant dose of uncertainty into the financial markets. Investors tend to react negatively to uncertainty, leading to increased volatility, price swings, and potential sell-offs as they try to assess the potential damage to corporate earnings and the overall economic outlook. This volatility can be particularly unsettling for those nearing retirement or with a shorter investment time horizon. The disruption of global supply chains. In today's interconnected world, goods often cross multiple borders before reaching their final destination. Tariffs can throw a wrench into these intricate global supply chains, forcing businesses to find alternative suppliers, which can be more expensive or less efficient. This disruption can lead to production delays, increased costs, and ultimately, lower profitability for companies that rely on international trade. The escalation of international trade tensions. Tariffs are rarely implemented in a vacuum. They often provoke retaliatory measures from the affected countries, leading to a cycle of escalating tariffs and trade disputes. These trade wars can have far-reaching consequences, damaging international relations, hindering global economic growth, and creating a climate of instability that negatively impacts investor confidence. The ripple effect on currency markets. The imposition of tariffs and the ensuing trade tensions can also have a significant impact on currency exchange rates. Increased uncertainty can lead to a flight to safety, potentially strengthening certain currencies while weakening others. This can have implications for international investors and businesses engaged in cross-border transactions. Quantifying the potential damage. Numerous economic models and analyses have attempted to quantify the potential negative impacts of widespread tariffs. These projections often point to a reduction in global GDP growth, job losses in certain sectors, and a significant drag on consumer spending. While the exact figures may vary depending on the scope and duration of the tariffs, the overall consensus among many economists is that they tend to be economically damaging in the long run. Navigating the storm. Strategic. All right, Finance Compass navigators, we've thoroughly examined the potential threats posed by tariffs. Now, let's shift our focus to what truly matters: how we can strategically position our investments to not only weather this potential storm, but also identify potential pockets of opportunity. Remember, in every challenge lies the seed of a new beginning. Fortifying your portfolio with defensive stocks, the anchor in the storm. In times of economic uncertainty and market turbulence, defensive stocks act as the reliable anchors in your portfolio. These are typically companies that provide essential goods and services that consumers will continue to demand regardless of the economic climate. Think of sectors like utilities, water, electricity, gas, consumer staples, food, beverages, household products, and healthcare, pharmaceuticals, medical devices. The demand for these essential goods and services tends to be relatively inelastic, meaning that even if prices rise slightly due to tariffs or broader economic pressures, people will still need to purchase them. This provides a degree of stability to the earnings and cash flows of these companies, making their stocks less volatile during market downturns. Concrete examples. Consider companies that produce everyday necessities like Procter & Gamble, PG, Colgate-Palmolive, CL, or food giants like Nestlé, NSRGY. In the utility sector, companies like NextEra Energy, NEE, or Consolidated Edison, ED, often exhibit relative stability. Healthcare giants like Johnson & Johnson, J&J, or Pfizer PFE also tend to be more resilient during economic contractions. The timeless appeal of gold and precious metals, a safe harbor in rough seas. Gold has long been considered a safe haven asset, a store of value that investors turn to during periods of economic uncertainty, geopolitical instability, and inflationary pressures. Unlike stocks or bonds, gold doesn't rely on the performance of a specific company or government. Its value is often driven by fear and uncertainty in the broader market. When traditional asset classes like stocks experience significant volatility due to concerns about tariffs and trade wars, the demand for gold typically increases, driving its price higher. Other precious metals like silver and platinum can also act as safe havens, although their price movements can be more influenced by industrial demand. Practical implementation. Investors can gain exposure to gold through various means, including physical gold, bars and coins, gold exchange-traded funds, ETFs like GLD or IAU, and shares of gold mining companies. However, investing in mining companies carries additional risks related to the company's operations and management. Strategic investments in real estate, tangible assets in an uncertain world. Real estate, particularly in robust and growing markets, can offer a degree of stability and potential for long-term appreciation, even amidst tariff-related uncertainty. Unlike financial assets, real estate is a tangible asset with intrinsic value. Rental income can provide a steady stream of cash flow, and property values can appreciate over time. However, it's crucial to conduct thorough research on local market conditions. The impact of tariffs on specific real estate sectors, e.g., industrial real estate reliant on imports, needs to be carefully considered. Interest rate fluctuations, which can be influenced by broader economic conditions, also play a significant role in the real estate market. Exploring REITs, real estate investment trusts. REITs offer a liquid way to invest in a diversified portfolio of income-producing real estate assets without the complexities of direct property ownership. Different types of REITs specialize in various sectors, such as residential, commercial, industrial, and healthcare. The indispensable strategy of diversification. Spreading your sails across different winds. Diversification remains the cornerstone of sound investment management, especially when navigating uncertain economic waters. By spreading your investments across a variety of asset classes, stocks, bonds, commodities, real estate, sectors, technology, energy, financials, healthcare, and geographic regions, domestic and international, you reduce the impact of any single investment performing poorly. When tariffs create headwinds for certain sectors or regions, other parts of your diversified portfolio may continue to perform well, helping to cushion the overall impact. This approach helps to mitigate risk and improve the potential for long-term returns. Implementing diversification. Ensure your portfolio includes a mix of asset classes that have historically exhibited low correlation. For example, bonds often move in the opposite direction of stocks during periods of market stress. Consider diversifying your stock holdings across different sectors and market capitalizations: large cap, mid cap, small cap. International diversification can provide exposure to different economic growth cycles and reduce reliance on a single country's performance. Focusing on companies with fundamental strength. The pillars of resilience. In a turbulent environment, the underlying strength of individual companies becomes even more critical. Look for companies with strong balance sheets, low debt, ample cash reserves, consistent earnings growth, a history of profitability, and a competitive advantage in their respective industries. These fundamentally sound companies are better positioned to weather economic headwinds, including the potential impact of tariffs. Companies with strong pricing power, meaning they can pass on increased costs to consumers without significantly impacting demand, are also more resilient in inflationary environments caused by tariffs. Identifying strong companies. Analyze key financial ratios such as debt-to-equity ratio, price-to-earnings ratio, return on equity, and free cash flow. Look for companies with a proven track record of innovation, strong management teams, and a clear understanding of their market and competitive landscape. Exploring strategic international investments beyond domestic borders. While U.S. markets will undoubtedly be affected by U.S. tariffs and retaliatory measures, there may be opportunities in international markets that are less directly impacted or even benefit from shifts in global trade flows. Thorough research and understanding of different countries' economic conditions and trade relationships are crucial. Certain emerging markets with strong growth potential and less reliance on trade with the U.S. might offer attractive investment opportunities. Similarly, developed economies with different trade partners and economic structures may exhibit greater resilience. Considerations for international investing. Be mindful of currency exchange rate risks, political and economic stability in the target countries, and the potential for different regulatory environments. Investing in international ETFs or mutual funds can provide diversification and professional management. Staying vigilantly informed. Your compass in uncharted territory. In a rapidly evolving economic landscape shaped by potential tariffs, staying informed is paramount. Keep abreast of the latest news, policy announcements, and economic data releases. Understand the potential implications of these developments for different sectors and asset classes. Follow reputable financial news sources, economic research institutions, and analysis from experienced market commentators. However, be discerning about the information you consume and avoid relying solely on sensationalized headlines or unsubstantiated rumors. The role of Finance Compass. We are committed to providing you with timely, accurate, and insightful analysis to help you navigate these complex times. Stay tuned for our regular updates and in-depth discussions. Navigating the nuances. Important considerations for every investor. The crucial element of a long-term perspective. Staying the course through short-term squalls. Investing is a marathon, not a sprint. It's essential to maintain a long-term perspective and avoid making rash decisions based on short-term market fluctuations driven by tariff-related news. Trying to time the market is notoriously difficult and often leads to missed opportunities. Focus on your long-term financial goals and your overall investment strategy. Market volatility is a normal part of the investment cycle, and periods of uncertainty often create opportunities for patient, long-term investors. The imperative of prudent risk management. Aligning your portfolio with your comfort level. Understand your individual risk tolerance and ensure your investment portfolio aligns with it. If you are a risk-averse investor, you may want to allocate a larger portion of your portfolio to more conservative assets like bonds and defensive stocks. If you have a higher risk tolerance and a longer time horizon, you may be comfortable with a larger allocation to equities. Regularly review your portfolio and rebalance as needed to maintain your desired asset allocation. Avoid taking on more risk than you can comfortably handle, especially in uncertain times. The value of professional financial guidance, your trusted co-pilot. If you feel overwhelmed or unsure about how to navigate the potential impact of tariffs on your investments, consider seeking advice from a qualified and reputable financial advisor. A professional can provide personalized guidance based on your specific financial situation, goals, and risk tolerance. They can help you develop a comprehensive financial plan, make informed investment decisions, and stay on track to achieve your long-term objectives, even amidst economic uncertainty. I understand that navigating these discussions about tariffs and their potential impact can feel like traversing a complex and sometimes daunting landscape. But remember, you are not alone on this journey. Here at Finance Compass, we are committed to being your trusted guide, providing you with the knowledge, the insights, and the unwavering support you need to navigate these challenges with confidence and clarity. Thank you for charting these important financial waters with us here on Finance Compass. We sincerely appreciate you being a vital part of our growing community. Remember to like this video if you found it insightful, subscribe to our channel for more crucial financial guidance, and share it with anyone in your network who could benefit from understanding the potential impact of tariffs and how to navigate them strategically. And as always, stay informed, stay strategic, and most importantly, stay financially empowered. We'll see you on the next